So what whole life insurance product should you select? Well, in this video, we are going to go through limited pay whole life insurance policies, which have some really nice advantages and also some disadvantages. So if I'm considering, or if you are considering a whole life insurance policy, really what I want awareness around are the different products, different features. How do I maximize the cash value? How do I maximize the flexibility? How do I get information, or how do I make sure I'm told information so it's not one of those situations where I get into a product thinking I have the best option, then it's like, oh, if I would have known that, I would have done things differently. But it was too much information to take in at once, or so-and-so didn't tell me, whatever it might be. So let's get on into it. We're going to provide awareness. With limited pay products, what that means, limited pay, is you can pay into the policy or premiums are due for a limited number of years. For example, if I were to look at a 20-pay policy, what that means is that I, as a policyholder, can make payments for a maximum of 20 years. I don't have to pay into it for 20 years, but that's the longest I can pay into it if I wanted to. With a whole life 65, 65 represents the age that I can make premium payments if I'd like to, premium and PUA payments. Now, do I have to pay that long? No. But unlike a traditional policy where I can pay into it up until age 100, 121, 99, which no one ever funds that long, those I can pay forever. An L65, an L20, a 10 pay, a 15 pay, those numbers represent the maximum number of years I can pay into a policy if I wanted to. This is the L65, then it's age 65. So a lot of info there. With respect to the actual product features, if you were to look at a 20 pay or whole life 65, they've got some advantages, but if you were to compare them on a guaranteed and non-guaranteed basis to any of the other products, it typically, in my opinion, doesn't make sense to go with them. Sometimes it does when you look at the numbers, depending on my age and circumstances. But what you'll find when you really compare the cash value buildup is if you do everything right, all things equal from a premium and PUA limitation, juice the cash value, you will find very, very comparable values between a 20 pay, whole life 65, and an L100. Or a higher cash value, or even a hybrid product. With the difference, with these guys, you can keep paying into them if you want, whereas with this guy, a 20 pay or whole life 65, you would be forced to stop. So, with all things being equal, if there's any chance if I say, hey, I might want to keep on going, and I can do that with one of these, whereas with a 20 pay or whole life 65, I can't, doesn't always make sense. Now, progressing on to the other guys, these ones I like, a 10 pay or a 15 pay. The drawback is in the name. 10 pay means you can pay into it for a maximum of 10 years. So if someone said, I want to pay into a policy for at least 20 years or up until age 65 and I'm 30 now, a 10 pay or 15 pay will not be the way to go. However, if you're looking for maximum cash value, maximum internal rate of return, like that is your goal. How do I juice the cash value? These products will do the trick for you. Now, I'll also add that different companies have different advantages or treat their limited pay products differently. If you were to look at Guardian, for instance, if I look at their 20 pay, whole life 65, even their 10 pay, and compare it with their L95, it's not a huge difference when I look at that. Just how the products and the crediting rate is actually treated with those products. With MassMutual, there's a big difference. Partially because of how their PUA rider fees work, they're lower with these products, and their guaranteed rates are lower with these products as well. With a 15 pay, I've got a 2.5% guarantee. With a 10 pay, I've got a 2% guarantee. And we cover that in more detail in other videos, our All About MassMutual video, for example. But with these guys, they are really designed to maximize cash value IRR. And MassMutual is very deliberate in the design of these products as well, maximizing the cash accumulation. That's what these products are for. So as we look at them, getting into the details here, what you would want awareness on from a product standpoint is what's the advantages and specifically how do they work. So the advantage is maximizing the internal rate of return. That's what you'll see with these products, especially if you want to fund it for a short period of time, call it 15 or 10 years or less. Premium dollars, beginning with the 10-pay product. Anything you pay toward the premium piece, you will see between 30 and 35%, again, of the base premium, specifically referring to the 10-pay product, show up in cash value in the first year. Beginning the second year, you see just about all of that premium come back to work for you. Now, base premium dollars do purchase me a death benefit right off the bat as well. That's the purpose of premium dollars, but they begin building cash value, about a third of it in cash value immediately. In the second year, you see almost all of it come back. So you're getting more equity based on your payment initially, which is nice. PUA dollars, like all products, show up in cash value. All right, that's great. The 15-pay product, however, works a little bit differently. So if we look at the 15-pay, let's underline this in gold. Anything I pay toward the base premium component, you'll see a little bit more than 25% in cash value right off the bat. So in the first year, if I have a $10,000 base premium, specifically with a 15-pay whole life insurance product with MassMutual, I'll see about 25% of that base show up in cash value year one. Okay, that's great. Now, the 10-pay did what? Between 30 to 35%. So why would I not always choose the 10-pay? Well, an item to consider, 15-pay, you can fund longer than 10 years. That's number one. The second is this. When it comes to payment flexibility, you having the ability to adjust payments up and down each year without any medical underwriting, you can do that with MassMutual's 15-pay product, which specifically has to do with MassMutual's LISR rider. And you can do it with the 10-pay product, but it doesn't look that good. It takes away a lot of the attractiveness, especially of the upfront cash value, if you add LISR to the 10-pay product. I'm going to show you examples throughout this video as well as we go through it. So let's look at some numbers, shall we? We will begin with the 10-pay product. We're going to look at 100K per year going in, just like all of the examples, which means we will set the MEC limit at, guess what? $100,000, which allows you to minimize the death benefit as much as possible to juice the cash value. That's what I'm talking about. So as we look at this policy, whole life 10-pay, we see it in the top right-hand corner. Where is your money going? So limited pay whole life product, here we go. Premium piece, $10,000 base premium. That is your underlying base premium. Total of $100,000 per year going in. Before I just zip to the numbers, renewable term rider. So with the 10-pay product, I will often elect not to use LISR, which is a one-year term rider, and use a flat, it's a level term rider for the first 10 years. Why they call it a renewable term rider is beginning year 11, the premium does begin to renew each year and increase. But for the first 10 years, it is level. I like that with a 10-pay product because it really allows me to maintain a 10% base premium and juice the cash value. The advantage to this product is if someone said, here's the dollar amount I want to pay in, I want the strongest internal rate of return possible, I like MassMutual as a company, and I do not need or want flexibility. I'm perfectly fine making this payment year in and year out. You do have some flexibility. I want to be clear on that, but you do not have the flexibility that you would benefit from with another MassMutual product where we can attach LISR and a bounce payments up and down each year. And you can attach LISR to this, it just makes it not quite as attractive. You'll see what I mean shortly. So here, 100K per year going in, $10,000 base premium. There's your 100K going in. Cash value, right off the bat, almost 90%. Very cash rich. Again, MassMutual, with the 7702 update, did a couple things with their 10-pay product particularly. They did with their 15-pay too. They did not increase PUA rider fees, which they did on all of their other products, and just about every other company out there did that as well. So they did not increase PUA fees with this, which really helped the cash value up front. And then second, they lowered commissions quite a bit on their 10-pay and 15-pay product. A lot of agents weren't happy about this in the industry because they're saying, hey, here's a cash-rich product, but they're really slicing down the commissions. It's quite substantial compared to what it used to be. But at the end of the day, you know our stance on commissions, more or less do the right thing, being in the business, and the money will come. If the consumer likes this type of product, show it to them. You do not want a situation where they find out that it existed if you did not show them. Just do the right thing, the compensation comes. A lot of people will be attracted to this. Look at this guy. You'll have the strongest long-term IRR with this option, breaking even a clean year 4. Now, if dividends drop, we actually ran this example with a dividend drop from 6% down to 5%. It pushes the break even out to year 5, but that's still very, very healthy. And that's really a testament to the design more than anything else. But here, breaking even year 4, funding it for 7 years in this example, and then stopping with nothing else going in thereafter. MEC limit, just over 100K in this example. So we solved for the minimum death benefit possible in order to be able to stuff the cash value year in and year out with PUAs. That's exactly what we wanted to do. So we're going to compare this to the Lister rider, or the same product with Lister attached. Here we go. That's our 15-pay. There we go. So on the left, we've got the example we just looked at with the renewable term rider attached. Not flexibility, but maximum cash value, maximum internal rate of return. 100K in the first year, 89.5, almost 90% by year 4. You've paid in $400,000 and you have $400,000. Here's your annual IRR, what you're earning year over year, and then here's the average, what I have earned after 5 years, after 10 years, after 20 years. What's my average internal rate of return? That's the distinction between the two. So as we look at this, cash value continues to grow. IRRs are quite attractive. They designed this policy for cash accumulation, and they're very intentional about stating that as well. Now, looking at the example to the right is the same 10-pay policy with one difference. We attached a Lister. You'll see that the death benefits are very, very comparable. But what Lister does is really force the base premium higher, usually with a 10-pay product more than anything else, which sacrifices the upfront cash value. People will feel this. Think of it, if this is you paying $100,000 into a policy, option A, you've got 89, almost 90%. Option B, you've got 83, about 84%. That's a hit. And that's over a $5,000 hit there. Is that something you're comfortable with, which gives you flexibility? That's the cost, because now with this option, because you have Lister, you can adjust payments one time per year on your anniversary date. That's really the advantage here. But it pushes the break even out. It's technically year 5 here, not year 6. The IRR is not a huge difference, but when you look at it, so if we go down to year 25, we've got 1.78 million compared to 1.76 million. $20,000 difference. Was it worth the cost of $20,000 to build an additional flexibility is the question. It's going to depend on the individual. And here's really what I would look at. The 15-pay, so if we go to that guy, here we go. 15-pay policy, we can add Lister to it. Where's the money going? So it's not a clean 1090 split, but remember, of the base premium piece, you get about 10%, 25% of the base premium that shows up in cash value in the first year alone. Meaning, of that 15.5, about $11,000 does not show up in cash value right off the bat. So here's my point. This has a Lister, so you can adjust payments up and down each year. 100K goes in. Oops. Got about 86% right off the bat. Break-even point falls between years 4 and 5. Okay, there I go. Cash rich right off the bat. strong early cash value, strong long-term cash value. But the main difference between this and the 10 pay, I get stronger upfront cash and can adjust payments year in and year out. Looking at the Excel comparison sheet, there we go. Let me go back to the 7 pay. Guaranteed values, and then the non-guaranteed values that we just looked at. So you'll see the same thing, same trend here. Guarantees don't look bad at all. Breaking even between years 9 and 10. And this has a 2.5% guaranteed rate. There's the 7 pay. Annual IRR. Average IRR, look at that, 0%. Then we've got the current dividend rate, 100K per year. Breaking even between years 4 and 5. If you look at the average internal rate of return on the far right, it looked very comparable to what we looked at before. And then here is your year 25 cash value. Almost 1.75. So very similar to that 10 pay and 15 to the two 10 pay products we looked at before. A little bit higher than the one with Lister, but here I get more cash value up front, can fund beyond 10 years, can adjust year in and year out. It's interesting how it works. But overall, I know this video was a bit deeper than the other product videos we had. The main advantage to limited pay products, really to summarize, is they often give you a stronger internal rate of return. If you know, you're very certain that you're not going to want to fund longer than 10 years or longer than 15 years, they can be a great option. They can be a fantastic option with a 1035 exchange, which we've got some other content, and we'll be creating more content on that in the future. But 1035 exchanges and limited pay products can look very, very good, guaranteed and non-guaranteed. But limited pay products, strong internal rate of return. If you're certain that you don't want to fund beyond 10, 15 years, whatever the product is, that's where they're great options. If you want to fund longer, not that attractive. Company selection also plays a big role. We mainly focused on MassMutual because their limited pay products are attractive. In most cases, people don't select limited pay products with other carriers that we use. But it's really just a means of providing transparency, see the options at the end of the day. It, of course, depends on what you're looking to accomplish. So I hope you enjoyed this one. I love the technical videos. If you did, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.